get it all back together.
Can we just do this?
Say it again.
So Professor Legge, I have a question.
Yeah,
So when you said like far as like with the market capitalization, is that basically saying like you're calculating that they basically gave you the price per that share that's currently trading times?
Yeah, market capitalization refers to equity value. So it's the current stock price times the number of shares outstanding.
Okay, see, I was assuming that was like the V or like the value of it, so that's why I had put that at the bottom. If I would have known that was I would have added both of them together for the denominator, and then had every single one separately for the numerators.
Yeah, so I think you had all the rest of it. Yeah, market cap always refers to the value of the company's equity. It does not include and it's not enterprise value, which includes debt as well. Okay,
perfect.
So now that you corrected that, Chaz, what'd you get?
Well, now I have to go. I still didn't do it. But
you know.
Yes, ma'am.
Okay. So when we look at the cost of equity, we want to look at the percentage of debt financing, and so it's the 140 million of debt divided by debt plus equity, about 520 million, and then so we're 26.92% debt financed. The rest of it is equity finance since there's not any preferred stock. So I could have calculated the cost of equity as 380 million divided by that 520. But if 26.92% is debt finance, the rest of it, or 73%, is equity finance. So we put that into our formula. They gave us the cost of equity at 11%. They gave us the cost of debt at 6%. Unless they tell you it's an after-tax cost of debt, presume it's not. And so multiply it by 1 minus the tax rate to get to an overall cost of weighted average cost of capital of 9.04%. Everybody good with that? Any questions on how we came up with a cost of capital? Okay, now this problem is a real valuation problem. This is really how we decide if a company should acquire another company. And so it's a little bit more complex. It's everything that's in Chapter 6, just sort of amped up. And so clearly I'll post this later today. But what we have to do is we have to figure out the cash flows, just like we were doing in Chapter 6. So they tell us EBIT in year 1 is 16.8 million, and it's going to grow at 10% per year for 5 years. And then and then we're going to have some stable growth in future years. So once I know my EBIT in year 1, I multiply it by 1.1 to get the EBIT the following year. Multiply that by 1.1. Okay. They tell us our taxes are at 38%. Remember, we ignore interest expense when we're doing cash flow analysis because we capture interest in a different way, and we come up to a net income number. Now, I need to convert this to operating cash flow, and for operating cash flow, it's EBIT plus depreciation minus taxes. Since depreciation was already taken out of EBIT, I need to figure out what the depreciation is each year. And the problem tells us it's at 8%. So this line here, is, it's not a messed up, out of order income statement. It's just because this EBIT number already has depreciation pulled out, and I need to add it back in order to get to this operating cash flow. So I just calculated my depreciation. It's 8% each year. Okay, so my operating cash flow is EBIT plus depreciation minus taxes to come up to this number. Okay, so those are my operating cash flows. And now, as accountants, this should feel familiar to you when we're trying to figure out overall value for the company. So it's sort of a cash flow analysis. We have operating cash flow, we have capital spending, and the problem tells us it's 15% of EBIT each year. Our net working capital is 9% per year, and so we can calculate these two numbers. So if we're looking at our overall cash flow from assets, we're going to do our operating cash flow, less our capital spending, less our net working capital to come up with our cash flow numbers for each of the first 5 years. Now, it would be nice if we could stop there. But this, when we purchased Joe's, it's not going to only exist for 5 years. Our expectation is that a company's existence, it goes on forever. So we have to calculate a terminal value. And in doing so, there we go. Oh, my marks are still here. Okay, so for our terminal value, the growth rate is at 3%, and it is based on the it's based on the cash flows in year 5, and the year 5 cash flow that we just calculated is this number down here, this 11.3. And so we have cash flow of 11.3%, a cost of capital of 9%, and a cost of capital of 9%, and a growth rate of 3%. So when we put that in the formula, much like when we were doing the dividend growth model earlier, we have the cash flow of 11% times 1 plus the growth rate divided by R minus G. Well, R is just our weighted average cost of capital, and that gets us our terminal value of 192 million. Once we have that, we have everything we need in order to put it in the formula and figure out how much we'd be willing to pay for Joe's. We saw our cash flow in year 1, in year 2, year 3, year 4. Year 5 has a cash flow plus the terminal value to get to this 204 million. We discount this at the 9% to get to an NPV of 161 million. That's the value of our firm. Joe's got 40 million in debt, so we pull that out to get to the value of equity of 121 million. Because if I'm buying a company, I'm only buying their equity, so I need to figure out the equity value, but I got to figure out the overall firm value first. They have 1.95 million shares outstanding to get to a price per share of 62.17. What questions do you have about this analysis? This one is complex. That's why it's one that I think you would confuse yourself more than resolve the issues if you went into the room and did this separately. I'm going to show you part B in a second, but I would like you to look through this before next time and come on back and ask me any questions you have. I'll probably do a run through of it again in class next week after you've had a chance to absorb some of the numbers that are here. It is the same thing we were doing in Chapter 6, except now you're valuing a company, and in this case, we're valuing them for 5 years before they become constant growth rate. Okay, we used a standard growth rate formula for the terminal value. Part B says, well, we don't like growth rates. We want to use a multiples approach instead. And the multiple that we have is the EV/EBITDA is 8. So it is 8 times EBITDA in year 5. Well, if we go back to the formula, we see that in year 5, we have EBIT of 24.596 million. Well, if that was our EBIT in year 5, we can add to it the depreciation of almost 2 million to get to an EBITDA of 26.5 million. So instead of calculating the terminal value using the growth formula that we just did a second ago, we can do it using multiples instead. And the 26 million worth of EBITDA times a multiple of 8 gives us a terminal value of 212 million. Whereas a second ago, when we had a terminal value, it was 192 million. So the number's a little bit higher here. And after we put that number into the formula to come up with our value of the firm of 166 million. So the only thing we replaced was the terminal value this time. 166 million, we pull out that 40 million in debt to get to equity value of 124 million, divide by the shares outstanding to get our price per share of 64. And when we're valuing a firm, this is very much what we do. We use a couple of different models. So when we use the growth model, we came up with the value of 62. When we use the terminal value, we came up with a growth model, a share price of 64.92. So we would probably be looking to pay somewhere between 62 and 65 bucks a share for Joe's when all is said and done. This is a harder problem, no doubt about it, but it encompasses absolutely everything in the book, and it moves you into how to take these concepts that you're learning, apply to a project, and apply it to actually valuing a company. As you move into CFO roles, you're going to be doing this, trying to decide if you're working for a smaller audit company and you're looking to be bought by one of the bigger companies, or if you're a bigger company, you're looking to acquire another one. This is the exact exercise you go through in terms of determining how much you'd be willing to pay for the company. So that is the extent of chapter 13. What questions do you, Sean, do you have a question? Yeah, just
sorry, I was just stretching.
Okay. Chaz, you look really pensive. That's a lot. Yeah, this is a big problem. Let's face it, our exam is 1 hour. You don't have time to do this in an hour. That's the good news. But understanding these concepts, that's why we'll walk through it again next time. I want you to read it, I want you to look at these slides, and I'll walk through it at the beginning of class next time, just to give you a sense for how powerful these tools really are and how you can use them in different applications than just whether we should buy a piece of equipment or build a new factory. They're used extensively anytime we do any kind of valuation work. Chaz, do you have a question?
Yeah, so we're not going to do nothing like far as like when calculating. It's not going to be nothing like to this extent where we have to calculate like whether it's like one problem, or would it be more of like, okay, here's the numbers, you know, would you like, how would you interpret this, or and like which decision would you use? Would it be something more like in that nature, or?
Well, let's see. You will be doing a cost of capital problem. So you'll have to calculate a weighted average cost of capital. You'll also be doing a capital budgeting problem, but not this extensive. Let's face it, if I gave you this problem, you couldn't finish it in an hour, even if we practiced them a whole bunch. It just takes too long. So you're not going to do anything this extensive. But the problems in Chapter 6 where you're doing a capital budgeting problem, those are fair game. So yeah, even though this problem is more complex than what we would do on a test, building out a spreadsheet you should be able to do. Okay, converting from a pro forma income statement to cash flows and then discounting cash flows to find an NPV, you should be able to do that. And we'll go through that. We'll go through next time. I wrote it already, but I write it and I set it aside and then I look at it a couple of times. I think at this point there's 6 questions on there. 2 of them you're going to have to use Excel or a calculator. The others are just short answers. So there's one short answer I don't love right now that I may switch up. But in general, it's very doable in an hour. You're going to have to work pretty consistently and be really comfortable, know how to calculate a weighted average cost of capital. If you can do this cost of debt and you can calculate a CAPM and you can do market values, that problem shouldn't take you all that long. This stuff is, to me, harder, doing the cash flows in Chapter 6 and making sure you're comfortable with those kinds of problems. You can do the problems we do in class, other than this one. I know this one's a little bit hard, but if you can do the problems we do in class, you're going to be in pretty good shape for the test. Okay, any more questions before we end for today? Can I finish right on time? Okay, so next time what we're going to do is I'll walk through this problem, we'll do review of the week, and then we're going to do chapters 10, 14, and 16 very quickly. Look through, watch the videos for those chapters. You'll see there's no problems in there, and it's pretty much narrative stuff that I want you to be familiar with the concepts before you leave, but in the scheme of things, it's not nearly as important as Chapter 6 or 13. Okay? You guys have a great week. I will see you in person next week. Bye, guys.